Hi, this is Chris from Skilled Wealth, talking to all of my Money for Life program clients. We're here today looking at what happened in the stock market in America on Thursday the 4th of October, yesterday. The reason I'm doing this is because I have spent the majority of today talking to clients about the massive movement down. And I say massive movement because they're the words that are being used to me. In reality, the share prices, as we know, go up and down, and sometimes they go sideways, and it doesn't really have a bearing on the way that we invest. You've got to remember that we invest for the cash flow. We want to know how much money can we make immediately, upfront, guaranteed in our pocket today. But I do understand that investing can be emotional, and particularly for our clients who've never really been into trading in the markets before, this can be somewhat of a disturbing movement. Why is it disturbing? Because the media tells you to be disturbed. The media tells you that it's the end of everything. We've been in what we call a bull market for the last 9 or 10 years. A bull market means we've been in an upward moving market. So the bulls, as they call them, the very positive people, bull in a china shop. We've been moving forward and forward and forward, making money on money on money on money. The media would have you believe that has come to an end. And now we've had one day of a movement down. As far as they're concerned, the world is coming to an end, amen. That is not the case. And I'm going to prove to you today, using a very simple set of charts, as to why we're not concerned what's happening in the marketplace right now. Before we do that though, I'm going to talk about why the market actually did come down last night. Because it was extremely predictable. And you know what? It was expected. And I'm going to show you that today using two different charts. The first chart I'm going to refer to is what we call the 10-year Treasury bonds. Now, the Treasury bonds are obviously bonds that are issued by the government, particularly in America. That allows them to bring money in, people can come in and invest, and they pay them an interest rate. When those interest rates go up, of course, we see a movement into the Treasury bonds. What we do see is movement out of the market into those bonds because they're paying a good interest rate. The problem is though, with interest rates come additional expenses, obviously, because you have to pay the interest back. And what I'm going to show you now is that the interest rates last night on the 10-year Treasury bonds actually spiked. And because they spiked, it spooked the market, because the market's thinking if we're paying more in terms of interest, then we're going to be in a situation where ultimately we're going to have lower profits. You see, it's not the Treasury bonds interest that the companies are worried about. It's that if the Treasury bonds interests rise enough, then the Fed, or the Federal Reserve over in America, may very well be in a situation where they rise or raise their interest rates on everything. Just like we have maybe in Australia, where we have the RBA talking about interest rates. Well, the Federal Reserve in America controls the official interest rate over there. And of course, if they start increasing rates, then the cost of borrowing money increases, the expenses for the companies increase, and therefore their profit margins decrease. And that has a direct reflection on the prices that companies will have on the stock market. So, let's have a look at the Treasury chart first, and then I'm going to refer to the S&P 500 chart and explain to you some very key points and why everything that's happening right now is okay. So here we're looking at what we call the TNX index, or the 10-year Treasury charts. And the most important thing for you to understand here, if you're not into technical analysis, it's okay. It's not difficult. I'm going to explain some very, very easy to understand fundamentals now. The blue line that you see here is what we call the 50-day moving average. That is very simply the price of this particular index worked out over a 50-day period, divided by that total amount, and this gives you basically the price for the day of the 50. The burgundy line down here is the 200-day moving average. And what I want to show you right now, probably the most important thing for us to understand, is where the share price, or in this case, the percentage rates for Treasury bonds over the last 6 months have actually been sitting. And if we use these horizontal lines, makes it very, very easy, we can see that the price, particularly for over the last 3 or 4 months, has been sitting between this channel. Okay, so we see that the percentage rate has been down this period of time. Well, here we are on the Wednesday here, when you see the cursor moving around. This was the Wednesday movement. We saw the interest rates on 10-year Treasury bonds increase dramatically and then continue up again last night, hitting the 32 mark. Now, 32 is actually 3.2%. We actually work it out on 1/10. So the 10-year Treasury results last night hit 3.2%. Why? Well, very easily to understand this. The reason it went up is that the American market, the economy is so strong at the moment, and when we have somewhere like Italy, for example, which is the 3rd largest economy in the European Union, start to have concerns about their economy, which has been happening over the last couple of days, when we compare those economies together, we can see that the interest rates have been increasing simply because the American market is outperforming everything out there today. When obviously the market is good, interest rates rise. We see that all the time. When the economy believes that they can afford to charge more, then they do. And of course, with that increase in pricing, we tend to have what we call inflation. And you have to understand the American market is extremely hot right now. They've got the minimum amount of people unemployed. They've got fantastic profits coming out of their companies. The last reporting season was absolutely sensational. We're in the throes of a 9 or a 10-year bull run. So we're seeing profits increasing. We've had massive amounts of tax deductions, particularly corporate tax deductions, occurring in the US, which has seen profits skyrocket even further. They're now starting to see interest rates rise. They're also starting to see wages rise, because if wages rise, then obviously people can afford to pay more. If they can afford to pay more, then they will. It's as simple as that. When people have more disposable income, the price of services and products increase. That's no different with interest rates. And that's what we've seen happen here in the last 2 days. So with an increase in those interest rates, we're starting to get the general marketplace worried that the Federal Reserve might think, well, this is a good opportunity to raise interest rates as a whole, which will then start to have an impact on the production and the profit margins of big companies, which will ultimately remove some of the profits that we've been experiencing, and therefore bring the share prices down. Very, very easy to understand. What I'd like to show you now is the S&P 500 and explain to you exactly what's happening with that index and why we shouldn't be concerned at all with these movements, because they are completely natural. Okay, so this is the S&P 500. 500 meaning that this is actually a combination, or an ETF, or in this case actually an index, an indice, that captures the top 500 companies on the American market, and basically with using different weightings gives us an indice that we can trade effectively on the market. Now, again, just like before, we have the daily movement here. In this case, we're looking at a 1-year daily candle. We've got the 50 MA, the 50 moving average, and also the 200-day moving average as well. And here we can see the large movement down in this red candle here, which was last night. In actual fact, this little white line below that red candle is the range that the share actually traded, in this case the underlying, traded all the way down to before it retreated back up in toward where it started on the day. We call it a red candle because the share price actually opened up at this level here, 2919, and ended up closing down here at 2903. Okay, so the share, or the underlying here, actually closed lower than its opening price. But what I want to bring to your attention is this. Back in January, this was the highest point that this index had actually traded at. And I'm going to put a horizontal line on there because that's a very important line for us. Okay, so this is the highest point. And again, we're looking at a 1-year chart here. So this was the highest point back at the beginning of this year, 2018. And we can see that the share price itself here has really been sort of tracking up with the 50 MA and moving away from the purple line, which is the 200 MA. Now, for those of you who follow the market, you will remember that back in January of this year, we actually did have a correction in the market. And you'll remember back then all the doomsayers were out saying, that's it, the end of the bull run, the market's come to an end, everybody's going to lose their money, there's death and destruction and fire and brimstone. And guess what? There wasn't. Yes, for those people who are doing buy and hold type strategies, or people who were in a scenario where they were shorting the market perhaps, yeah, they got stung big time. But you know what? It didn't affect us at all. Because you see, our clients in the Money for Life program understand that we don't care whether the share price is going up, going down, or going sideways. Now, the reason I'm bringing this level of attention to you here is that from a technical point of view, when we're talking about a correction in the market, we're talking about a correction is defined as a drop of 10% or more. So if we were to actually put an arrow in here and have a look and see whether or not that was a drop of 10% or more, let's bring that high point all to the low point, and we can see that that was actually just on 11, almost 12%. So from a technical point of view, from this highest point to the lowest point down here was actually almost 12%. And from a technical point of view, that is the definition of a correction. Let's put that into perspective with what's happened last night. So we've hit our highest points up here. And again, let's just put a horizontal line in there for us. Beautiful. So this is the highest point that the market has been trading over the last couple of weeks. And let's just change that down to a 6-month chart so that we can zoom right in and see what's happening here. So these are the highest points. This was the movement that we had down last night. This was the highest point that we traded back in January. We've continued that line through. But this movement down between here and there, if we were to put a arrow on that, we can see that effectively we're talking about less than a 2% drop. So in the last 24 hours or so, the market has had a small movement down of about 2%. But we can see that the share price, or the underlying here, generally runs with the 50 MA, and when it comes down to the 200 MA, tends to use that as what we call a support level, bounces off it and moves back up again. So we've got what we call a confluence here, where this particular line, which was the highest point back in January, is actually hitting the 50 MA. You can actually see the 50 MA slightly above that highest point. So from my perspective, what I'm thinking about, for my clients particularly, is that the value of this underlying share is going to come down to that point, use it as a resistance line, use it as a support line, bounce off it and move back up again, which is generally what does happen. Now, it doesn't mean it's going to happen. So if the value of this underlying share continues to drop, then I would expect it to come down to its next point of support. And I would suggest that that next point of support is probably going to be sitting somewhere along this line here from a technical perspective at around about 2,790, 2,800. We're at 2,900 at the moment. So it's got to drop at least another 100 points before it will see some sort of support. And then I would suspect that the value will go back up. And note how it's come down to the 200. It's come down to the 200. It's coming down to the 200. This is something that is just normal. It happens this way all of the time. So I'm not concerned at all where I see the value of this underlying coming down. I think potentially it could bounce off that and head back up. If it doesn't, that's okay. It may continue to come down. Now, I would only be concerned if the value of this particular underlying share came down to or lost approximately 5% of its value. Let's have a look at what that actually is represented by if we add another arrow in here, what 5% actually looks like. Well, there you go. 5% just happens to be the very same level that we have identified already as being our main support line. So, if the value of the underlying comes down to that level, still I'm not concerned, because I believe that the value of the underlying share can very much come down to this level and then rebound off there and move it forward. If we were to have a major correction, let's have a look at what that would look like in terms of the pricing. From its highest point where we are now, 10% actually sees us at the levels all the way down here. Come up a little bit, there you go. 2,650. We are well and truly away from that level now. And more importantly, that level is so far below the 200 MA that even if we look back over the 12-month daily average, daily candles here, we would be back to where we were basically back in November of last year, back to where we were in March of this year, May of this year. We've been here before and look where we are now. So I want to reassure you that in terms of where we are right now, this movement down is completely expected. There's a rational explanation for it, and that's simply because interest rates obviously are starting to go up from a treasury point of view. We're worried about the fact that the Fed might turn around and increase interest rates across the board. That would be a concern for the marketplace. But these major support lines that are here are there for our benefit from a technical point of view, and we can see that we've hit these levels before and we've recouped from where we've been, continuing to go up. And from our perspective, particularly with the Money for Life program, we don't care. We really don't care. We see that this is just a normal breathing of the market. This is the way that market works. And the benefit for our clients is that even while they're asleep, they're actually still making money. So that's what's going on in the market at the moment. Guys, look, thank you very much for listening to me with this update. Went for a little bit longer than I expected, but there was some very interesting information and there's a lot happening in the market. And the one thing that I really want to say to you is this: we don't necessarily need to get bogged down into the day-to-day nitty-gritty of what's happening in the marketplace. The strategies that we employ are very, very easy to understand, very easy to follow. A 3-step process can get you to generating income to change the way that you're living today with as little as maybe 30 minutes a month worth of effort on your behalf. The clients that we have at Money for Life program have enjoyed the benefits of making money even while they sleep. As I've said, it's one of the benefits that they have for what it is that we do. It's been a privilege talking to you today. Please jump onto our webinar, have a look at it, follow the prompts as you go through, see how easy it is for you to become part of this money-winning strategy. And I look forward to talking to you in the future because, guys, this is Money for Life. Bye for now.